Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, inflation numbers on both sides of the border around 4 or 5%, and those are the official numbers. Are they telling us that's all the inflation there is, or is there a lot more?
Oh, well, it's just the CPI basket, of course, and we found out that for October, the official CPI in the U.S. came in with a 0.9 increase, which was a 6.2% annualized rate, which is the highest rate in 31 years. However, it's also noteworthy that if you X out autos and rent, I know people get really upset when you X out certain things. Some food staples are no doubt much higher, but autos and rent are two particular anomalies because they are a direct function of this highly financialized system we've really magnified in the past 18 months as all the fiscal and monetary stimulus efforts flooded into the financial markets and made a certain portion of the population have all kinds of excess liquidity to funnel into things like investing in real estate or, speculating in real estate, flipping in real estate, all this good stuff. They bought up really all the houses, and because the math doesn't make sense, because the prices are so high, to buy and rent out really doesn't make any sense in most cases, and so they buy it as either a land bank or on the presumption that they will be able to flip it. So this has really drained rental supply because no one is looking at that as a viable economic enterprise in this price range. And so that particular component, because there's been this crunch and shortage of properties available to rent, because there's been this excessive amount of liquidity flowing into speculation in housing, we've seen that price of rent go up, and that's really inflated the CPI. As well on the autos front, back to fiscal policy, we saw this amount, massive amounts, trillions of dollars flooded directly to consumers post-pandemic or post the start of the pandemic, and that really incented a lot of people to go out and change their vehicles. It made a shortage of vehicles because at the same time people weren't traveling, and so rental companies, sold off their fleets at the very outset when the crash happened in terms of people not traveling, not renting vehicles, and so all of a sudden the whole at the same time, you got the supply disruption and the sudden demand surge for durable goods, which made a shortage of semiconductor chips, which we know are widely used in automobiles. And so you had these supply disruptions, you had this unusual surge in demand, and this cheap financing which was available, and that funneled into the vehicle sector. So we also saw this huge jump in auto prices. But those two things are, I think, temporary because of the factors that I've described, because of the fact that we aren't continuing to see ongoing emergency wage programs rolled out to directly funnel money into households, because we are now seeing that people are having to try and find work again, and that we have had actually a decline in real wages for 6 of the last 7 months. So this is where you get this rubber hitting the road, where you've got this spiking cost of living for some of the factors that I've just mentioned, but the fact is that real incomes are not, that income gains are not keeping up with the cost of living increase. And so you have this slowdown now happening throughout the global economy. And you've got at the same time, because these inflation numbers are lagging, and they come out, backward looking after the fact, you get a jump in rate hike expectations. So as of as of the recent numbers of inflation, you have now 3 hikes in the Federal Reserve's base rate forecast into happen between now and 2022. So that's more than there was before this report. But interestingly, you have 2 major factors which are undermining my faith that we're going to continue to see that kind of inflationary pressure persist. And one of them is the bond market remains unconvinced. So we did have a jump in the short end of rates yesterday in terms of bond prices at the short end selling off, which meant their rates were higher. But at the long end, the yields rose much less than the short end. So essentially we're getting this flattening of the curve. We actually saw an inversion in the yield curve where the 20-year yields were actually a little higher than the 30-year yields. Today, of course, being Remembrance Day, the North American bond markets are closed. But as we look at the numbers as of yesterday's close, this is what we're seeing. So the Treasury yield curve has been flattening for several months now, from basically the peak of inflation expectations, which was around in March. And since then, we've had the U.S. dollar leap. So again, back to this, the currency really leads the whole thing, the base currency being the U.S. dollar for most of global trade. As global trade is slowing, as the U.S. is spending less, as consumers are struggling more, they're having, less dollars are flowing into emerging economies. So we're seeing less imports coming into America as a major consumer in the world. And the U.S. dollar is back now to the highest level it was in July of 2020. So it has gained not just against the U.S., not just against the Canadian dollar, but also against a basket of world currencies. And at the other end of the teeter-totter, of course, you've got the commodity sector, the CRB index, which is comprised of, all the major energy and food staples, that sort of thing. And that's all been falling. We only have a handful of commodities which now remain elevated. Most of the most economically sensitive things like lumber and iron ore and steel and aluminum and zinc and all those things have come off significantly in the past few months. And that didn't change yesterday. So as the U.S. dollar rallied yesterday, we saw that sell-off in commodities continue, which is the anti-inflationary story. At the same time, the Baltic Dry Index, which is the shipping, index for goods around the world, is off more than 50% from its peak a few months ago. And in consumer inflation expectations, we're actually flat. And consumer sentiment is back at the lows of March of 2020. So you put all these things together, and I would suggest that you have to keep your eye on the actual amount of dollars that people have left to spend in a consumer-driven economy, which is both the United States and Canada, consumption-driven. We've had this crunch, both on savers who have less income from their savings. Yields are much lower on all asset classes. So that has really crimped the spending capacity of those that are so-called retired. At the same time, and as I said, we've had a loss of jobs, and we've had a loss of participation because a lot of people have not gone back to the workforce, especially in America, where the vaccination rate, for example, is about 57% double vaccinated in the United States. In Canada, it's about 75%, so we have seen more labor participation gains in the past year than in America. But the bottom line is that we have less people working. And overall, incomes are lower and cost of living is higher, and this is slowing spending throughout the whole economy. And because it's slowing spending in the most affluent countries, of course it's slowing income coming into emerging markets and developing economies. And at the same time, they are holding record amounts of U.S. dollar-based debt. So while the U.S. dollar rises, the servicing costs are jumping all over the world. 40% of S&P 500 companies earn their revenue in foreign countries, so that when they translate that back to U.S. dollars on their annual and quarterly financial statements, that cuts into corporate profits. And those are the trends that are dominant right now in the world, and that is why I believe it will be a self-correcting mechanism in the sense that this inflationary aspect, not only are we starting to solve the supply bottlenecks and constraints, but we've seen this ramp up in efforts to produce product, in efforts to ship product. We've got record amounts of inventory, waiting to unload, waiting to transport out. just at the time that demand and incomes have already come back down. We did have that big jump in household savings, especially in America, because of the 3 stimulus packages that gave checks directly to Americans, but the household savings rate has now come back down. People still have some excess equity in terms of in their homes because prices have gone up significantly, and the asset prices, if they're in the stock market, the small percentage of the population that has been exposed to that has seen that part of their net worth go up, but that is also a highly fluctuating and vulnerable increase given all these other circumstances that we're talking about.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. You mentioned just towards the end rents and people speculating in homes. What is that doing for the average person who's trying to either rent a place or perhaps buy a home?
Well, we know that in Canada it's become absolutely obscene for people to try and buy a property in most places in the country. The gains in the last year in terms of the pricing of things is 25 to 30% in general, depending on, where exactly people are looking to buy. I was speaking to a realtor friend just yesterday, and I was asking her for, micro actual stats on her busy practice in the area just north of Toronto where I live. And she was telling me that, she's had a record year for sure in terms of transactions. But when I asked her, what percentage of her households are using, for example, all cash, the answer was 2% of her transactions were all cash deals. The bulk of them were financed. And even where people have 20% down and incomes, her clientele tends to be on the more affluent side, which would suggest which she said suggests they have incomes, household incomes of more than $200,000 a year. Even them, 97% were using financing to buy their properties in this environment. And although banks are looking for significant down payments, I mean, even if you put a 20% down payment on $1 million home, you're looking at an $800,000 mortgage. So, all right, the interest component is cheaper here where, rates are under 3%, 2.5%, or floating rate mortgages right now in Canada are under 2%. But the interest rate component remains at the very low end of historic norms, but the principal component remains at the very high end of historical norms. So you have this, the net effect is that the payment per month, comprised as it is an extraordinarily large amount of people's disposable income. And that leaves less resilience for any kind of job loss or shock, but it also leaves them less money to spend in the general economy. And then, she was also noticing that there's a good amount of homes being bought in Canada with numbered companies. Again, this whole, opacity where people are not actually sure who's buying a house. And in many cases, she was saying, again, they're not buying them typically to rent them out because the math doesn't work. So they're buying them to flip them. Whether they do anything significant to improve them is a question. Sometimes there is renovations going on. Other times it's just a quick flip and not really anything significant has happened to the property. So we've seen that model, for example, really catch up to, in Canada, that's been, this insane amount of our GDP has been driven by this activity. In the last year, we saw that we're now more than 4 standard deviations above the long-term mean in terms of it's about 10.5% of our nominal GDP is coming from this residential financing and buying and selling activity. And if you look back, I put a chart on the blog since 1947 to give you a sense. The peak of those real estate cycles, the peak of the about 8 cycles that have happened since 47 were all when that component or that percentage of GDP got above 1 standard deviation. In the 6.5 range of GDP was the peak of that cycle. Well, we're now 4% more above that. And similar trends have begun to unfold in the United States particularly since the pandemic hit. As we know, the U.S. had a housing bubble peak in 2006-7, where thereafter prices collapsed 40% nationally, and they really stayed low for a number of years. And it wasn't until the last sort of 2018 and on that we saw this huge, again, QE policies, cheap money flooding into the investor class with low yields and uneconomical pricing on most assets, including equities, corporate debt being, at record highs and record low yields. So the amount of opportunity for anyone looking to make investment allocation is very limited in this environment, and so people have really funneled it into housing. And the general thesis has been, well, if prices are high, we need more supply. But actually, what we've got is a massive amount of investor class funds and individuals and private offices holding a bunch of properties, as I said, as land banks, as some were to put it, on the expectation that they would just flip it at some point. We have tax policy certainly in Canada and the U.S. as well, which favors this kind of flipping of properties. The capital gains laws, that sort of thing, are very, very generous to this particular asset class. People use a lot of leverage because the government's backstop the mortgage market in terms of helping, through Fannie Mae and through CMHC to allow liquidity in this space. But even, you marry the algorithmic obsession and trends that have happened in terms of internet interface in the last couple of years. So you've got companies like Zillow who actually created an algorithm that it was automatically buying properties, sight unseen, just buying properties. And of course, some genius has put in a equation that it presumes that if you buy it within X number of days, you'll be able to resell it for X profit. And so again, sight unseen, this algorithm has been offering funds to buyers, to sellers, and buying thousands and thousands of homes. And then indeed this month, they noted that the trends have become so extreme. In places like Phoenix, for example, prices are already falling because the investor class has funded too much supply in this area not in terms of affordable rentals, but in terms of this properties that are, as I say, designed, or the buyer designed to buy it at a high price and flip it at a higher price is the whole point. So they began to notice they were losing funds on these transactions because the algorithm only expects one-way price movements. This is classic, right? They only expect that prices will go up, and they've taken annualized rates over the past couple of years of appreciation and said that it should rise, 1 or 2% per month. So 6 months from now, the price should be 6 to 12% higher. This is the kind of nonsense that passes as, investment genius or analysis these days. It's just plugging in these one-way bets. And so what indeed happened was that Zillow's now announced this week, that they're going to start selling properties that they've bought using this algorithm. And there's about 18,000 homes coming onto the market, and they're going to lose money on all of the properties that they're relisting, but they realize that it's a lot harder to do this in this market environment where everything has become so discombobulated and disconnected from, any kind of economic sense. And so I think that that's just a canary in the coal mine for that kind of thing, where we're going to see more and more people and pressure come on, because of course as soon as this investor class in funds and ETFs and REITs and all these people that have piled into these type of instruments, looking for buyers at these rates in terms of prices is going to be very difficult. And if rates, mortgage rates moved up a little bit in the last while with this backup, with the inflation, consensus and yields coming higher, and right away you're seeing kind of panic in the finance markets in terms of the housing financing, where people are trying to lock in low rates and desperately looking for things to buy. And of course, no one's been doing inspections because you have to make unconditional offers in this market. So it's really become just a frenzy, a free-for-all, and it's likely that that's going to end in its typical and normal way, which is that, prices will probably drop nationally and in certain pockets by much more than the average. And a lot of people that have bought with high levels of leverage are going to be burned. And now, as I said, we've had this concentration in our economy in terms of reliance on this particular sector to an extreme amount. So that suggests that it's just going to be one really negative impact for the economic growth of the countries, on both sides of the border.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. We'd like to salute our veterans and current serving members of the armed forces and their families. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.